In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a quarter percentage point.
The Fed lowers rates, but Chair Powell says a December cut is not certain. Alexander Morris of FM Investments joins us. Alex, stocks were higher given the rate cut, but then the market started to sell off when Chair Powell said that a December cut was not a foregone conclusion. The market has heavily priced in that December cut. So what does that mean for stocks going forward?
Well, stocks also reclaim some of that initial drop, which I think was the market adjusting to this. The Fed futures market quickly adjusted to that news as well. Chair Powell did walk some of that back over the course of the press conference, but did try to make clear that the committee isn't united in its view of what's happening. A sort of wide variety of opinions, meeting that dearth of information, has led to different views of the market. Stocks, I think, priced in this thinking it was an absolute foregone conclusion, even though Chair Powell says it's not a foregone conclusion. It still feels pretty likely to continue this, particularly if the labor market does continue to crack, which Chair Powell went out of his way a few times to point out that that was happening, and there was this inflationary pressure that was likely, perhaps a one-off increase in prices from tariffs, but there is some concern that those tariff one-offs are very quickly going to become permanent, and that mixed together will give stocks some room to really question this.
Chair Powell today was asked about AI, particularly because we saw massive AI-related layoffs at Amazon this week. Do you think that Chair Powell thinks that these AI-related layoffs will impact an already weakening labor market, and will that affect Fed policy going forward?
And I think most of these job cuts are being blamed on AI, but we don't know that they're actually AI related. They feel very much just standard business cycle for a large company that did a lot of hiring. And I think Chair Powell made clear they didn't want to answer specific questions about any one company or any one decision, but they certainly gave the view that they don't feel that AI is weakening the job market yet. That may happen at some point, but they don't see wholesale labor market cracking as a result of AI. They see that from just natural parts of this cycle and their job and in executing the dual mandate. But it is clear that some of these job losses will be blamed on this. There likely to be more. And the promise of AI is indeed to recontour the labor market and how we apply our labor to company value creation. We saw that happen with robotics, and we thought that was going to end every person working on an automobile manufacturing floor. There's more people there now than ever because we need people to train the robots and do things related to it. AI likely has that promise in the long run. In the short run, though, there's just not enough data to show that this is actually the cause of AI and that it is widespread. And it's clear that the Federal Reserve is not ready to make that call yet either.
What are your thoughts on what we did see today, which was the expected 25 basis point rate cut with 2 dissents and an end to the drawdown of the Fed's balance sheet?
No surprises here. Steve Myron comes in at a bigger cut, and more surprised that we saw a vote for no cut at all. But I think the real story is the end of QT, something many of us were expecting to happen the end of the year, beginning of next year, which this is the Fed no longer trying to put capital out of the market, right? QE, its natural inverse, is injecting capital into the market by buying assets. They're no longer to be selling that off, which will put a little bit of pressure on the US dollar. Yeah, QT was propping up some of the dollar. But other than that, the Fed delivered more or less what it said against a relatively dearth of information, right? With the BLS shut because of the government shutdown. And instead, I think, did a very prudent thing, stuck to message, stuck to plan, and delivered a cut that the economy needs as we shift into worrying more about the labor market than we do about inflation.
So let's talk about that blackout of data, because the personal consumption expenditures report is due this Friday. That's the Fed's preferred inflation gauge, and we likely won't get it because of the government shutdown. So how do you see the Fed proceeding ahead?
The Fed will have to carry on using its own models, which going into this most recent round of inflation, the Fed had a great deal of confidence in. And then inflation happened and that confidence quickly eroded. But as we've heard from Jay Powell before, the Fed's confidence is being restored in their ability to model both inflation and and the labor market, and they feel confident now to make those decisions. We probably won't get PCE. We did get CPI 2 weeks, better late than never, as a result really of the government needing to price in Social Security COLAs and other things. We're not going to get that, I think, just to give the Fed a slightly easier task. But regardless, I think we all can pretty readily know the number that's going to come out of this isn't 2. It's not what the Fed was looking for, but the Fed's motives have now changed as the risks have been more balanced, and now the need to prop up a potentially cracking labor market has just outweighed any effort that the Fed has for a terminal 2%, which, by the way, the Fed has always been shooting for 2%. It has a hard time sticking that landing. It's always a little bit high or a little bit low. Janet Yellen ran the economy hot, as we called it. And here, I think it's going to make some sense for the Fed to really start considering other factors. And inflation is difficult. Mass unemployment is deeply unpopular. So being close enough will have to be good enough for the Fed for the time being.